So I'm getting a message that we are finally live on YouTube and on Twitter. So technical delays aside, welcome everybody. I'm James Early. This is the first ever, the first annual, the first monthly, the first weekly Curia investment show. We want to make you a better investor, and we want to outcare every other research firm out there. So please help us do that. Ask questions, chat in the chat box, subscribe to this channel, and let's learn together. Today's show, we'll have 3 investment ideas for you. But before that, we'll talk about the US government's stake in Intel, whether soaring AI valuations are worth it, and Federal Reserve independence, or why the bond market may be losing a little faith in the US of A. And because this is the first Curia investment show, I'll introduce these 2 handsome gentlemen sharing the screen with me and give them a little quick mental math test, because you don't really know somebody until you've seen them squirm, right? I'm kidding. Todd Lechtenberger is one of my Curia co-founders, and he was my first hedge fund boss 25 years ago. Simon Erickson of 7 Investing is our special guest and my former colleague from the Motley Fool. And I'm James Early, founder and CEO of Curia and a longtime professional investor. So Simon and Todd, thanks for joining me.
Thanks for having me,
James.
Awesome. So Simon, we're going to jump right into a story that I'm going to toss to you, and that's Intel. Can no strings attached grant money just transform into a strings attached equity stake? Well, apparently, yes, according to the Trump administration, which is converting an $8.9 billion sum of, let's say, undispersed grants from the CHIPS Act, the Science Act, and something called the Secure Enclave Program into a 9.9% stake in Intel at a price lower than the market price. Now, this ownership is passive, no board seats or voting control per se, but the government will pay just over $20 a share instead of Intel's current price, which is around $25. So taxpayers are getting a deal, and Uncle Sam is giving itself warrants to buy another 5% of Intel at this same low price over the next 5 years if Intel loses a majority control in its foundry unit. So it's sort of motivation for Intel not to sell that. So Simon, a lot to unpack here. This is many things to many people. To some, it's a shameless land grab, a dangerous precedent. To others, it may be a smart national security move, an alignment of interest to jumpstart a critical U.S. sector the U.S. has fallen behind in. What is this to you?
This is, to me, a 2-beer conversation, James, because this is a lot to unpack. Like you said, we've got about 10 minutes to go through probably a 10-hour conversation. Maybe we'll go with 2 coffee conversations instead of 2 beers, I guess. The punchline in this is really the world depends on 3 very large chip makers for the vast majority of all of the computing chips that are made. The first is Taiwan Semiconductor, who appropriately is based in Taiwan, Samsung based in South Korea, and Intel here in the United States. And as you've noticed, the security of domestic supply is more and more important to the United States, certainly as geopolitical risks are rising between mainland China and Taiwan, who it wants to reunify with the country. Now, the curious thing about Intel is why? Why are we structuring this as a 9.9% equity stake when this was previously granted as a no strings attached CHIPS Act grant to Intel? There was no equity stake granted under the Biden administration. Now the United States says, hey, we want a 10% stake of this for the $11 billion in total funding that was previously released to them. It's an interesting question, because even if the government, holds on to their ownership stake for a couple of years, it might make a couple $1 billion off of it in terms of financial, James. Probably not a whole lot of money to move the needle for the United States government. But I think more interestingly is there's going to be influence and maybe even a little bit of spying on what's going on with Intel. The U.S. wants to ensure domestic supply. It wants to make sure that if anything happens in Taiwan, it's got at least a supplier that can make those chips for NVIDIA, can make those chips for Apple, from all those Silicon Valley companies that have traditionally relied on Taiwan Semiconductor for their manufacturing. Keep in mind, Taiwan Semi makes 70% of the world's third-party foundry chips and 90% of the most cutting-edge AI chips that are 7 nanometers or below that are necessary for AI applications out there. So I think that more than anything, this is not a financial move. This is a national strategic importance move.
I just got to ask, can we do it? I read these articles about Taiwan Semi importing U.S. engineers into Taiwan for like these 2 or 3 year training programs, and they come back to the U.S., to Arizona, these fabs they're setting up there. and the Americans just struggle. Like just to be candid, I love America, but they don't work as hard. The ethic, the way of following instructions, there's a cultural aspect also. The U.S. has not been a manufacturing powerhouse, and I think it costs more than double to make a chip in the U.S. relative to Taiwan. You could argue national security has no price, but like, how much ROI do you think we're going to get here?
I would personally say minimal. I'm pretty pessimistic about this, actually. I don't think it's actually really good for Intel to have the U.S. as a 10% owner of the company. First and foremost, $10 billion is not a lot of money when it comes to building fabs. That sounds like a lot of money. It's $10 billion, but keep in mind a cutting-edge fab is $40 billion or more if you're building in the United States. And Intel's already committed to use this for its Phoenix, Arizona fab that it's working on right now. It previously had discussed building a mega fab in Ohio, which is still kind of on delay right now. But in the grander scheme of things, $10 billion is not a lot of money. And then secondly, James, Taiwan Semi has got such a lead in the technology for these process technologies are required for creating chips, right? We're now creating transistors that are the small little gates on integrated circuits that are 2 nanometers in size, right? And there's only 2 companies that can make those right now. It's Taiwan Semi and Samsung. Intel a couple of years ago brought back its previous boss, Pat Gelsinger, to try to, accelerate the strategic roadmap to try to get close to Taiwan Semi's technical league that they had. And he just wasn't able to get there. Intel had underinvested for decades in this. They wanted to kind of push the R&D agenda more to the front. And even with the U.S. government on board, you still have to go out there and prove that you can keep up with your larger rival. And 2, more importantly, James, you have to win the trust and the orders from the large tech companies.
Totally.
To be seen for either of those.
Yeah, there's not that many buyers of these big, especially the fancy semis. Todd, so to run with that view, Simon, maybe someone could say that money might be better spent protecting Taiwan, for example, than building up capacity in the U.S. Todd, as I turn to you, I'm going to show our listeners some notes on the screens. These are just from ChatGPT. Our analyst Xiaoping compiled these. There's actually a long history of the U.S. nationalizing companies, a lot more than I expected. From Montgomery Ward to some of these steel plants, it hasn't always gone well. And this one here, Truman failed to nationalize a steel plant. He struck down. In some cases, we nationalized Amtrak, and that's a big money loser. Anyway, long story short, I know you tend to lean libertarian on some of these matters. What do you feel about this move?
Yeah, I'm in just a caveat to what you said. I don't know about libertarian, but I definitely am a card-carrying kind of capitalist. And I just think the world is replete with examples of where kind of socialism or government intervention doesn't work. You don't have the profit motive there, so you don't have the incentive to make things the most efficient. That's where I stand. But typically anything related to chips or tech or something like that, which is a little bit out of my wheelhouse, I always defer to my friend here, Simon, who's obviously, from what you heard here, is very, very well informed on these subjects and these matters. So
Simon's pretty much informed about anything. That's my theory about Simon. I've never asked him a question that I don't get some really smart, like well articulated answer to.
Yeah, check from the mail, gentlemen. Thank you for the kind words.
I will add one other thing. I think there's a little bit of a Twilight Zone thing going on here when you have a personality and a person like Donald Trump and a personality and a person like Bernie Sanders agreeing on something.
Yeah.
So that's
it's a little scary when the far right and the far, not the Trump far right per se, but when the right and the left agree, it's either really good or really bad. Probably nothing in the middle.
Right.
Yeah, and if I'm a foreign company looking to park a lot of money in the U.S., it scares me a little bit. I mean, Russia has nationalized private oil concerns. Brazil did that recently. These are not governments the U.S. aspires to be, but at least optically, it looks like we are acting like them. So it's a little bit of a scary precedent, at least in my view.
Yeah, and just some final thoughts on Intel as an investment too. The company is struggling to figure out how it's going to make its money. For a long time, Intel Inside, right? The PC revolution was always Intel chips that went into that. The newest driver of cutting edge AI chips is in the data center. And we all know that Intel is not beating NVIDIA or AMD in the data center. It's actually getting replaced. Xeon processors are getting moved out of data centers and replaced by other chips. And so Intel said, well, we can manufacture, chips for here, domestic supply, and we can just get a bunch of money from the government. They want to do the same thing in Germany out there too. And now that we're seeing governments balk at that and even taking an ownership stake, I'm left with more questions than answers on what the future of Intel looks like 5 years from now. Not really optimistic, though, for me as an investor.
Yeah, are we throwing good money after bad? We may well be. Speaking of money and questions, our next story is simply of AI valuations. Some of these companies are OpenAI, for example. OpenAI has a $500 billion valuation, making it about the size of Netflix or MasterCard. That's pretty big and a pretty quick ROI for Sam Altman. Anthropic has a $183 billion valuation, which is also astronomical. It only looks small compared to OpenAI. The question is, are we in an AI bubble or not? And this is relevant to individual investors like you guys watching, because increasingly platforms like Republic, and I'm mentioning Republic because I know them personally, but there are other ones doing this. Robinhood is doing this overseas now, are creating ways to invest in some of these big private companies that are staying private longer via these, they don't want to call them derivatives, but they're basically derivative-like contracts, where in the case of Republic, you bet with Republic. You say, I'm going to buy an OpenAI at, I'm making up a number, $100 now. When it goes public in 3 years, whatever it is, Republic.com will pay you the difference between the current price at the last valuation round and whatever the IPO price is. And if they don't go public, they'll pay you the difference between the current price and whatever like the private market valuation deemed at that time is. So in other words, regular investors like us can invest in these companies without literally investing in these companies. So Todd, are we in an AI bubble? Should regular investors be trying to invest in these companies? Demand is huge right now.
Right. Well, I would say this, there's a lot of echoes today of what kind of went on in the .com era. A big difference, though, is these companies actually have profits. And in some cases, like back then, I mean, I can remember guys coming to my office with literally like a piece of paper and something written on it for some business plan. They got huge valuations. So it's different in that respect. These are real companies. I do think the valuations are extremely frothy. Again, being this is kind of the tech world, it's a little out of my wheelhouse, since I'm kind of a special situations value type guy. However,
you've been hand-wringing the whole time, so that seems like a value kind of guy, hand gesture, basically.
Yeah. So,
the Homer Simpson
evil master here.
Yeah.
I do.
The Grinch preparing to rob the Whoville.
The problem with a lot of these things is, if valuation can continue to run for a long time and get higher and higher and higher. So are they fairly valued now? I don't know. My guess would be no, that's frothy, but time will tell how this works out. And typically in these frothy things, once you have a kind of a correction, the cream will rise to the top, and the companies that are performing well and doing well will continue to do well over time. And so if you're a long-term investor, think back .com, if you were in Amazon over time, you've done extremely well.
Well, it's all about the ratios, though, right? I mean, for every Amazon, for every winner, and there are winners, they're going to be winners. How many also rans are there going to be? The U.S. has had 2,500 car companies come and go. Now we've got like 4. We've had 900 e-commerce companies come and go. Now we've got Amazon and eBay. We had 16,000 or 20,000 cryptocurrencies in 2017. I don't know how many I have now, but we're not going to end up with that many. So a couple of years ago, I wrote an article in Forbes about AI, and at the time there were 19,000 AI companies on Crunchbase. Last time I checked, there were like 70,000 or 80,000. Crunchbase is like a database of privately funded companies. So I agree with everything you're saying. From an investor standpoint, like for every winner, there are dozens or hundreds or thousands of losers. Obviously, OpenAI, Anthropic, those guys are already pretty well proven. So it's kind of like a calculus. Like, are they above the hump? Simon, what do you think?
Well, pardon the analogy, as I'm coming up with this on the spot, but for
You have
those
to
who
use it, it's going to be pretty good. So I'm excited already.
for those, yeah, we'll see. Don't say that until you hear. I promise there's a point to this, but for those who like '90s alternative rock, can remember Nirvana, one of the biggest bands of the '90s, and its famous frontman Kurt Cobain, who actually hated being famous, hated making money, hated being mainstream. And then when Nevermind came out in 1992, he actually hated it so much that every time he'd have to play "Smells Like Teen Spirit" live, he would play it as quickly as he could to get through the concert, just because he just hated what he had become, and it was just the complete opposite of what he was trying to accomplish with the band.
Interesting.
OpenAI is Nirvana of the AI age, right? If you remember, OpenAI was created to be like the counter force that would balance Google from becoming too powerful of an AI force out there, right? And you had Sam Altman that had a lot of really smart people, right? Mira Murati and Ilya Sutskever, all these super smart people that wanted to create an AGI, a safe AGI super intelligence to counterbalance Google using it for profit. And just like Kurt Cobain hated getting famous, it's almost like OpenAI hated becoming a $500 billion company that is now for profit. And you see a lot of their executives leaving and starting other companies that are going to compete against OpenAI now. It's almost like this virtual cycle of like, do we want AI to be used for good and safety and putting up the bumpers in place, or do we just want to go out and make as much money off it as we possibly can? This is the debate of OpenAI. Yes, it's made $12 billion in revenue last year from basically zero, 3 or 5 years ago. And there are projections it's going to 10x in the next 5 years too, by the end of the decade here. Or there's going to be more Anthropics and more, AI offsets. If there's not enough of a competitive advantage that this company is locked in with enterprises, they're going to have a lot more options in the next 5 years. It's the ultimate hockey stick VC investment, James. I mean, you could make a ton of money on OpenAI, even if it did come public at a $500 billion market cap, or I could just as likely see, hey, this has not got the staying power or the stickiness we thought it did, and it gets cut in half in the next 5 years.
Yeah, go ahead, Todd.
I was just going to say, if OpenAI has the same mindset as Kurt Cobain and not liking the profitability and the profits and making the money, they can actually reach out to me at curiafinancial.com, and I will take the money for them, take it off their hands to solve a problem. But go ahead, James, I digress.
Todd's the problem solver.
Yeah, I can solve that problem for them very quickly.
In addition to the kind of a histogram of a few successes and a lot of failures, you could also look at a time dimension of this, meaning even among the successes, if I were to have bought Microsoft in its early days, or Google, in 2007 or 6, like a little bit after its IPO, when everyone was saying, oh, it's overvalued, Google's overvalued, Facebook's overvalued, I would have made tons of money. But for every Google, there's a pets.com, something that looks good for a while, but isn't. So to me, the question is, and this is the unknowable philosophical question, is how much is AI going to change the world? The internet sure did, right? But in some case, one of our friends of Curia, Renee Brintrop, wrote a good Substack post about fiber optics and how these companies, Verizon, really invested big money in digging up everyone's yard and putting these fiber optic cables. And it eventually worked, but it took a good 10 years for that demand to catch on. So it's really about expectations versus current reality, like how economic is AI in terms of money. Right now, I think a lot more money is going into AI investment-wise than is coming back out.
I can help answer that a little bit, at least of where the money is going right now, because OpenAI and ChatGPT, it's free for us, and there's no advertising at all or anything on it. You can just go to the prompt and ask it whatever you want to. The money being made is on the back end, the computing of the cloud providers, necessarily Microsoft, exclusively Microsoft for OpenAI for the first couple of years. Now they're opening it up, but every time there's an instance, there's computing instance on whoever the cloud provider that's doing that computing is getting a little bit of money from OpenAI. It's very expensive to do this.
The picks and shovels, basically.
Right, the picks and shovels, exactly. So that's why you're seeing these CapEx budgets of like $100 billion a year for the computing, because it's expensive. It costs a lot of money to do this stuff. But now the companies like the OpenAI is saying, hey, actually, we can actually start charging money for this. They've got an API where you can plug ChatGPT into your own website, and they'll charge you for it. And then there's a new thing called agentic AI, where it can actually power these agents that are actually doing things, doing customer service work for you, booking trips for people that want to make vacation plans, settling, processing insurance claims, things like this, where big companies are saying, hey, we used to pay human beings, wages and salaries and benefits and compensation for this. Now we just pay, for instance, for this thing to be fixed. And by the way, they don't take vacations if they don't need health insurance. There's going to have to be another step to get to $100 billion of revenue in the future, like the projections are seeing, James. We can't just replace the American workforce with AI bots to do these things. It's going to have to make the pie bigger. That's the part where I'm scratching my head a little bit right now. We don't really know what it's going to look like. I'm not saying it's not going to happen. It's just unclear and undefined right now.
I think it's undefined too, but again, this is another example of creative destruction. I mean, I have a friend whose son is starting law school, and I asked what kind of law he was going to study. And, this wasn't around 5 years ago, but he's going into AI law. I mean, that was not a thing probably 2 or 3 years ago, and now it is. So there'll be new industries that pop up, people that have to service this stuff. I mean, you don't ever know how it's going to play out exactly, but we've seen this movie many, many times. You've seen the Industrial Revolution, you've seen the telecom boom, you've seen the internet boom, you've seen all kinds of things. So, I think in the long run, it's going to work out. But to your point, Simon, who knows how it's going to play out exactly. So.
And Todd, I would agree with you on that, especially since it's really hard to catch the lead husky in these races, right? The top dog that's running ahead of everybody. I mean, like we saw, what was it? Was it DeepSeek? Remember DeepSeek a year ago that was supposed to be the NVIDIA killer that, had a faster way to computing?
Yeah, for about 2 weeks, and then
didn't happen, right? And it's going to be very hard to catch OpenAI as well.
Well, speaking of sons, with Meta apparently offering some of these AI researchers $200 million pay packages, I will be disappointed if my son does not go into AI, because I want him to give me a nice, comfortable retirement. Speaking of retirement, speaking of bigger pictures, let me go on a little macro monologue, guys, and I'll let you guys weigh in. I want to talk about the yield curve. I want to talk about interest rates. I want to talk about gold and Fed independence, because they're all interconnected. There's a yield curve mystery these days, which is actually not a mystery. And if you're new to investing, a yield curve is simply the slope of yield curves by time. And usually you have an upward sloping yield curve, meaning near-term bonds pay lower interest rates. Then you go to 5 years, 10 years, 20 years, 30-year bond, you get higher and higher on that yield curve. Sometimes it inverts, sometimes not, but a normal upward sloping yield curve is kind of the general state of affairs. Anyway, what's happened lately is a bit interesting, because after a long time of not having lower rates, moron Jerome Powell, who runs the Federal Reserve, and I'm using quotes because that's Trump's term for him, not mine. I think he's actually a smart guy who's managed things pretty well. No one's ever fully happy with the Fed. He's telegraphed that he's finally going to lower rates, or suggest the Board of Governors lower rates later this month. And I'm going to share the probabilities of the CMA. This is a tool that FedWatch tool, basically 97, if I can read this right, 97.4% probability that rates come down. This is imputed by 30-month futures contracts on Fed funds. Anyway, so rates are finally going down. Normally, those are Fed fund rates. The overnight rates banks charge each other on their balances they need to top up at the Fed. Normally, though, corporate bond rates and government bond rates move in some kind of sympathy or lockstep, but now they're not. In fact, long-term bond rates have actually gone up. And gold is something like $3,500 an ounce, roughly around an all-time high. That's highly unusual when the stock market is up. But it's more the divergence of the Fed move in the bond market that's making people wonder. And I don't think it's a big wonder. I think bond investors, which tend to be, frankly, be a little smarter than stock investors, and we're stock investors, so I'm criticizing ourselves here, but are concerned about the future of the U.S., specifically the long-term future. That's why the short-term rates are still relatively low. Those are more likely to be a little connected with what the Fed is doing. But the long-term rates are higher because we're having a loss of faith. I think the big issue is simply the U.S. debt. We all know the U.S. has a ginormous amount of debt. I'm going to show a graph really quick here, too. I'm not the fastest with this stuff here, but I try. This is debt to GDP, debt as a percent of GDP, which has gone up and up and up. This is on Investopedia. But I think another issue is Fed independence. This is something that's in the news now. That's why I'm talking about it. We've had a very controversial attempt to oust Lisa Cook, and as we speak, that's going to be played out in the courts. We don't see how. I don't know how that's going to play out. And I don't know all the facts, so I can't comment too much. But it has a lot of people concerned. So I did a little research into situations where central bank's independence was compromised in some way. And I say this because the Federal Reserve Act explicitly separated the Fed from the rest. It was chartered by Congress, but separated it operationally from the rest of the government. The idea being to avoid political pressure. And in general, the political pressure could be in the form of please lower interest rates so the economy looks hot, looks good during my term from any president. Weimar Germany in the 1920s had a compromised central bank that led to hyperinflation and arguably opened the door to Hitler. Argentina in the 1970s and 80s had a compromised central bank, which led to hyperinflation. Zimbabwe in the early 2000s had the same thing, which led to prices doubling every 24 hours. Turkey in the 2010s, Erdogan declared interest the mother of all evil and got 80% inflation, which is, I guess, to him less evil. Even in the US during World War II, the Fed was subordinated to the US Treasury, and during the 1950s, the US had 8% inflation. That's our version of Zimbabwe. So for me, I am a little concerned about this. I'm not freaking out yet. We're not Weimar Germany yet, but hopefully the Fed stays independent because that's really the bedrock of our nation's financial credibility. So that's my monologue. That's my speech. I don't know if you guys have a reaction or not, but
it's an interesting time for the macro, James. You know, going back to the immortal words of Paulie D from the Jersey Shore, when in 2008 he said, "Buy gold, fool." Turned out to be spot on. You know, great investment advice there from a reality TV star. But it's interesting, right? Why is gold going up at the same time the stock market is, and also what's driving inflation right now, or what's even driving GDP? You know, we're so used to 70% of it being with the consumer. For the first time in the last quarter, there was more GDP growth in terms of absolute dollars that came from tech spending, CapEx spending, than there did from additional consumer growth, which is wondering, you know, it's just kind of curious, you know, typically GDP sign of the economy, you know, inflation kind of connected to that, ultimately to the consumer. It's almost like we're passing the torch to the big tech industry. And it's just a curious time. I don't know what that's going to mean for the macro.
If we didn't have that, where would we be, right? Yeah, we'd really be up a creek. You know, thank God. I mean, we just talked about AI being overhyped, right? But in a way, thank God for that, because that's keeping the spigot on. That's without that, job losses are increasing. The number of job openings is declining. Consumer confidence is going down. Consumer confidence is not really the best barometer of things, but for what it's worth, it's going down. Like, we're not looking at that good of an economy if you take out AI.
Correct. And inflation, or I'm sorry, it's not inflation. Unemployment has ticked up, you know, a couple hundred basis points last year. And if anyone has followed along with retailers, you know, the Crocs and the Lululemons of the world, the Chipotle world, I mean, they're all kind of saying the same thing. The consumer confidence is low right now. And a lot of them are even reporting negative year-over-year comps in the United States.
Yeah, it's scary. All right, so let's shift to what you can do as an investor to make money, because everything boils down. I mean, it's nice to learn about things. It's nice to hear opinions. But like, what are you going to do as an investor? We've got 3 stock ideas for you. These are not recommendations. I'm going to be very explicit about that. Don't run out and buy them. Just take them as starting points for further research. Simon, you look ready. So why don't you go first with your idea?
I'm buying stock in James Early with Curia Financial, because I've known James for 15 years. One of the brightest guys I've ever met. You know, I've known him for almost two decades now, and really excited, first of all, to be even here with you on the show, James. So I'm buying stock.
I'll send you that PayPal we're talking about for saying that praise later. But thank you very much. Appreciate that.
The publicly traded stock that I'm watching right now is a company called Duolingo. The ticker on that is DUOL. Appropriately, we're talking about AI. This is a company that's using AI for language learning. So you can actually go out there and learn 40 different languages, whether it's something easy like English or Spanish, but they also offer other things like Swahili and, yes, even Klingon on its popular mobile app. That's not a joke.
Got way too much time if it really is learning Klingon.
Not a joke. Seriously, Duolingo.com if you want to confirm that. But the thing that is interesting is that they last year offered a new higher price plan. Typically it was $60 a year for kind of their super Duolingo, the paid plan, if you will. And they just wanted to see what would happen if they embedded AI in it and allowed you to have a conversation with the AI and also learn at the same time, just to see if anybody would pay $168 a year rather than $60 a year for the regular plan. And it actually got a really very good reception. They increased not only the subscriber count, but also the average price per user. The stock is selling off because of concerns about Google entering their field. But man, Duolingo just grew the top line at 40%, converted 30% of it into EBITDA profits, and just raised its full-year guidance. I think it might be worth a second look.
Would
anecdotally, I'll tell you,
go ahead, Todd.
Canada this summer, I have two kind of middle-aged children, and I wanted them to do things other than just sit around all summer. So
middle age sounds like mid 40s, and so that would imply you procreated at the age of like 11, Todd. Is that accurate?
No, I'm sorry. My kids are in middle school. I am
middle school, not middle age. Okay, got it.
Sorry, they're in middle.
Hey, look,
I had my first child at 39, so I'm the old dad when they go to school. But my kids, I was like, hey, you should do this Duolingo thing. I'll do it with you. How's that? And so they kind of grumbled about it. And literally after a day or two, they liked it, and they're still doing it today. And my youngest had Spanish class for the first time this year, and she's like way ahead of everybody just because of this Duolingo. So I'm a big Duolingo fan, just anecdotally.
Awesome. Guys, let me interrupt. I was going to go to you, Todd, next, but we have two questions from the audience. One is from Ivy. For retail investors, is it smarter? This is related to AI. Is it smarter to buy Microsoft, Amazon, or NVIDIA rather than chasing private AI hype? What do you guys think?
I can go first if you'd like, James. I think out of the three of those, NVIDIA is the clear winner because it sells to both Amazon and Microsoft, and it's going to be the upstream winner that
it wins either way, right? It's platform agnostic.
Yep, exactly.
Yeah, and I would say with the other two, you're getting a little bit of AI, but like it's just like a small piece of a much bigger business. Whereas NVIDIA, it's not exclusively an AI company, but AI is a much larger part of their motif, so to speak.
I would defer to Simon. I agree with Simon. Also, private markets for individuals, you got the liquidity issue. So I would refer anything tech wise. I'm deferring to Simon.
So we got another question from Tiffany. Should retail investors treat gold as a hedge, or is it already too expensive? I'll stream on that. It's very hard to value gold, just like art, just like Beanie Baby or Labu Labu dolls, whatever, the new craze from China. Any collectible baseball cards, it's just worth whatever people pay for it. Gold has very minimal industrial use. That's like a low single-digit % of gold's use. So it's hard to know. But in my view, gold goes down more likely than it goes up. I don't know that it's a hedge when it's at all-time highs, when the stock market is also near all-time highs. So I would personally be a little bit too afraid to put more than a low single-digit % of my portfolio in gold. That's not investment advice. Everyone should determine their own allocations. If you look at a long-term history, going back 50 years, 100 years, gold has massively underperformed U.S. stocks. Now, there is a counter argument to that, which is if you look at a really long-term history of sovereign currencies, never in the history of civilization has a sovereign currency been like in power for more than like 300 or 400 years. And the US dollar is pretty much, run its course. And so maybe these gold bugs who think gold is going to go to $50,000 an ounce, it's $3,500 an hour, $100,000. Mostly, I think they're full of crap. Okay. They're ideologues who are angry with the government for some reason. And I'm not judging them beyond that. But if the dollar just falls apart, then what I'm saying is wrong. Then you're going to be glad you bought gold at $3,500 an ounce because maybe it's at 7,000, maybe it's at 10,000. But generally speaking, I agree with Warren Buffett. Gold is a barometer of fear. It's not so much a speculative investment.
Let me jump in here. It's Tiffany, right, who asked the question?
Yes, Tiffany says that.
So for individual investors, I'm a little agnostic on gold. I don't own gold. I've owned gold before, but not really as a hedge. But right now, I think we're in a very unique situation, and individual investors should take advantage of the fact you were talking about yields and the yield curve before. I mean, you can get treasury bills right now for the last couple of years. They've been floating back and forth between 3.5% and 4.5%. I think it's an opportunity for people to be patient. You know, before you go back 10, 20 years, if you're being patient, you weren't being paid to be patient. Now you can be patient, wait for your spots, use your cash, buy that 3.5%, 4.5% yield, get that, wait for Simon to come with a great stock pick. And then if you like it, then you can invest then. But and that's also acts as a hedge per se. I mean, if the market tanks tomorrow, you know, drops 20%, you're not going to get beat up on your, you know, 90-day treasury bills. That's what I would do as an individual investor. That's what I do. I'm not an individual investor, but that's what I do.
Might as well get paid to wait, right? Yeah.
Correct. You're getting
Yep.
paid to wait.
Yep.
And it's kind of a natural hedge.
So just I don't know, it's a question or a comment, just jumping on Ivy's point. Charlie the Crocodile, hi Charlie, says, good question relating to the AI private market. I would add what's more important in that comparison, or maybe he's asking, would it be just valuation or would it be illiquidity, transparency, and other differences between public and private? I think Todd, to your point, you'd answered that already, that you really comparing apples to oranges if you're looking at, you know, NVIDIA or Microsoft compared to a private investment in OpenAI,
Right.
Because of those things. And you get, by the way, the big thing with private markets, or one of the big things, besides illiquidity, besides having trouble selling, the information available is like a fraction of what you have in public markets. With public markets, we really have too much information. We're bombarded with information and we have to sift through it. With private markets, like, you know, you're lucky to get a bare bones financial statement. You get a lot less information, generally speaking, compared to public.
Right. And the flip side is too, you think it's hard right now to buy these companies, you know, to find some of that stuff to buy and participate in. You wait till a large market downturn, and good luck finding a buyer if you want to ever get out of that, especially as an individual investor.
Yep. So Todd, since you have the mic, why don't you share your stock idea next?
My big stock idea, actually, I'm it's almost getting embarrassing. I really like Simon's Crocs thing, and it got creamed shortly after he kind of went all in. But if I like it even more, I mean, it reminds me a lot. There's a Dillard's, which is not going to make sense to anybody. Maybe we can have a longer talk about this at some point, but it sounds a lot like a Dillard's trade that I did, and I still hold, and I've had for several years. And there's a lot of fundamental factors underneath it. But you know, when we start buying Dillard's, which is an old line retailer, I mean, they were $55 to $75, and now it's $575. This story about Crocs sounds a lot like that. Another quick one. I know we're supposed to.
Let me just interject for people who don't know you. The first thing Todd did was to order a pair of Crocs and order a pair of Hey Dudes, which is their kind of failed acquisition of these like fabric-y kind of shoes. Like, he put his money where his mouth is, and he'd see sample. Are you wearing them now, by the way?
I am not wearing them right now, but I do wear. They're very comfortable, I will say. And ironically now, I mean, whenever I do research, I mean, I do a lot of fundamental research. And,
you know, Todd, in body language, crossed arms is a gesture of defensiveness. So I'm wondering what your mind is.
I'm not defensive at all. I love my
Crocs. You're not. Anyway,
I love it. I was actually I was in Frisco, Texas this weekend. I was in a mall, and I hear the same things that Simon's saying about people not buying, and all. The mall was packed, and they had a Crocs store, and I went in there, and it was packed. And there was people buying stuff left and right. Now that's very anecdotal, and that's only one data point. But I do like, you know, it's a long-term play. I think Simon's onto something, and I really like that. Another one that I'm looking at, I actually own some of it because I owned it prior. There's a small cap company, Scholastic. They're the publisher in the United States for like Harry Potter's, Dogman, a lot of popular things. But it's kind of a special situation in the sense that the founder's son, who ran it forever and ever, it's like a 100-year-old company, he died a few years back. and it was kind of a family-run deal, and they didn't run it as efficiently as they could. Plus, they bought 2 large buildings in Soho, and they had their business in there. Well, the building value alone is more than, I think it's like more than half of what their market cap is. They're actually trying, now that the founder has died, or the founder's son has died, they're replacing the board with people that are kind of a financial background. So I think what they're going to do is they're going to sell these buildings, which I argued with them a long time ago in person that they should do that. Are you a real estate company or a publishing company? And then I think they're going to either return that cash to shareholders via a dividend, or they're going to continue to do buybacks, which they've been doing a lot of buybacks right now. They've got 2 parts of their business, the publishing, which I talked about, and then they sell a lot of these book fairs at schools and selling books. I can remember when I was a kid, when those things, you had to get those little onion skin paper deals. But that's something I'm really interested in, especially if it gets a lot cheaper. I think it's just it's not a long-term play. It's kind of like I said, it's kind of just a value opportunity, and there's a lot of unique things going on behind it, as opposed to just buying it just for the operating business.
When I was a kid, we had these not really somewhat forced book sales where you could go door to door selling books on behalf of your school. And if you sold like 500 books, you get like a plastic spider ring. It's like a horrible ROI, right? I don't know if it's the same company, but it
No,
sounds
I don't
familiar.
think that was the company. No, no.
That was a good marketing ROI that they had for that, though. Whoever did that company,
yeah,
spiders for selling 500.
Not the nicest guy, but a marketing genius. I'll say that. All right, so I'll go quickly with my idea. We can wrap up here. It's a KSO Bio. I'm going back to the well on this because I mentioned it in April at our Curia roundtable discussion. 9926 is their Hong Kong ticker. AKESF is how they trade in the US OTC. I think it's about a $16 billion, maybe a little bit more market cap company. It's up. It's up something like 350% since I mentioned them in April. Now, most of that is luck. I am not that much of a genius stock picker, but why I like this company, it's a truly innovative Chinese biotech. When you say Chinese biotech, you've got 2 very risky adjectives in the same phrase. Okay, so be super careful here. It is not a Me Too drug maker. They have a product called ivonescimab. It's a bispecific monoclonal antibody, which basically a type of mAb. Anything that ends with a mAb means monoclonal antibody. It targets 2 targets. PD-1, which is like a handshake a cancer cell does with your immune cells, and the cancer cell is very clever. It gives like the healthy cell handshake, so your immune system doesn't kill it. A PD-1 inhibitor puts a little like thing in the handshake of the cancer cell, so then the immune system says, it doesn't know the secret fraternity handshake. I'm going to kill it. And then VEGF, which is vascular endothelial growth factor. Keytruda is Merck's big cancer drug. It is the #1 best-selling by money cancer drug in the world. It's what Jimmy Carter got years ago. And this is a drug going head-to-head with Keytruda. And depending on how you interpret the trials, its drug might be performing a little bit better. It has a partner in the US called Summit. So Akeso Bio, very risky, but very big growth potential at the same time.
I would like to point out something for what you said. I believe you're being overly modest, Mr. Early. You made the quote, "I am not that much of a genius stock picker." I believe when you were at the Motley Fool, you outperformed the S&P for the entire 10 years that you ran the Dividend Income newsletter. Am I correct in that?
You've been reading my stuff, Todd, and I'm flattered. I'll send you your PayPal also. I got to pay my friends to compliment me, but hey, I'll take it. Thank you so much.
You're underselling yourself.
Well, that's why I got you guys here. I got to surround myself with the best, and you guys are some of the best stock minds that I know. And hopefully you guys watching at home have enjoyed this chat. It's our first one. We're learning. We were a little late to start because we couldn't quite get the tech figured out. So please bear with us, but don't be shy. Ask questions, post comments on YouTube, on Twitter, wherever you want. We're here to help you. We care about you. We want to make you better investors. That's pretty much what we're all about. So if you like this, please subscribe, CuriaFinancial.com. If you like Simon, go to 7investing.com. You can see what he has to offer. And please stay tuned because we'll be delighted to do this again. So Simon Erickson of 7 Investing, Todd Lechtenberger, my Curia co-founder. Thank you guys for joining us. And thanks to you guys for watching us at home.